Most people think saving $10,000 is about having money in the bank. It's not. It's about crossing an invisible threshold where the financial system suddenly decides you're worth paying attention to. Before that moment, you're renting access to stability. After it, something fundamentally shifts in how money moves around you. And almost nobody talks about what actually happens in that transition, because the people who've crossed it forget how strange it was, and the people who haven't crossed it yet assume it's just about the number. It's not about the number. This is about what changes when you stop being financially invisible. Here's the uncomfortable part. When you have $0 saved, you pay more for almost everything. Not because you're bad with money, because being broke is expensive in ways that don't show up on any receipt. Your bank charges you fees for not having enough money. $25 for an overdraft, $12 a month for falling below the minimum balance. That's $300 a year just for being poor in the wrong checking account. You can't buy in bulk, so you pay more per unit for everything from toilet paper to rice. You can't wait for sales. You can't stock up when prices drop. You're paying the scarcity tax every single week. Your car breaks down and you don't have $1,000 for the repair, so you put it on a credit card at 23% interest. Now that $1,000 repair costs you $1,300 over the next 2 years. Or you go to a payday lender and pay even more. You're not just broke, you're subsidizing everyone who isn't. A study from the Brookings Institution found that low-income Americans pay about 10% more for everyday goods and services than wealthier households. Same products, same neighborhood sometimes, different price because you can't afford to pay up front. That's the trap. You need money to save money, and until you have a cushion, everything costs more, which makes it harder to build the cushion. The $10,000 threshold is where that math starts reversing. The moment you have $10,000 saved, the first thing that happens is almost invisible. You stop making expensive decisions out of panic. Your car breaks down, but this time you don't spiral. You're annoyed, sure, but you're not choosing between the repair and rent. You're not sitting in a predatory lending office signing paperwork you barely understand. You just fix the car. That's not motivational, that's arithmetic. A 2019 Federal Reserve study found that 40% of Americans couldn't cover an unexpected $400 expense without borrowing or selling something. $400. That's one bad tire, one emergency room copay, one broken laptop. When you don't have a buffer, every small disaster becomes a financial catastrophe, and catastrophes cost more than problems. You get charged late fees because you had to choose which bill to pay this month. Your credit score drops, which means higher interest rates on everything you borrow going forward. You might lose your job because your car broke and you couldn't get to work for 3 days. Being broke compounds quietly, steadily, exponentially. But $10,000 breaks that cycle because now you're absorbing shocks instead of amplifying them. Here's the weird part. It's not really about the emergencies. It's about what happens in your head when you know they won't destroy you. You stop operating from a place of scarcity, and that changes every financial decision you make going forward in ways that are almost impossible to quantify, but completely obvious once you see them. The second thing that changes is more visible. The financial system starts treating you differently. Banks that wouldn't talk to you suddenly send you credit card offers with better terms. You start getting pre-approved for loans, not because you asked, because algorithms have decided you're less risky. Your credit score probably goes up because you're not riding the edge anymore. You're paying bills on time not because you're more responsible, but because you have margin. That higher score unlocks cheaper money, lower interest rates on car loans, better terms on mortgages, access to credit cards that don't have annual fees and actually give you something back. Here's the absurd part. The system rewards you for not needing money by offering you more money on better terms. When you're broke and actually need a loan, you get wrecked by interest rates. When you have money and don't need to borrow, suddenly everyone wants to lend to you cheaply. The difference between a 4% interest rate and a 10% interest rate on a $30,000 car loan is about $5,000 over 5 years. Same car, same person, different financial position, so different price. That's not a moral judgment, that's just how risk pricing works. But it means crossing the $10,000 threshold doesn't just give you options, it literally makes everything less expensive. And then there's the investment asymmetry. When you're broke, you can't take advantage of opportunities. A friend starts a business and needs early investors. Your company offers stock options, but you can't afford to exercise them. The housing market crashes and everything's on sale, but you can't buy. With 10,000 saved, you're suddenly in the game. Not rich, not even comfortable necessarily, but optionality has entered your life. You can take a slightly lower salary for a job with better long-term prospects.
You can move cities for an opportunity without it being an existential risk. You can invest in index funds and let compound interest start doing its thing. That's the part nobody tells you. The first 10,000 doesn't make you wealthy. It makes you less poor in ways that multiply over time. But maybe the strangest part is what happens to your brain. Behavioral economists have studied this. There's a concept called financial scarcity mentality, and it's not a metaphor. When you're broke, your brain literally functions differently. A Princeton study found that poverty reduces cognitive capacity, not because poor people are less intelligent, because financial stress occupies so much mental bandwidth that there's less room for everything else. You're constantly doing math in your head. Can I afford this? If I buy this, what can't I buy next week? Is this charge going to overdraft my account? That background processing is exhausting, and it makes you worse at planning, worse at long-term thinking, worse at seeing opportunities. When you cross 10,000 saved, that noise starts to quiet down. Not completely, not permanently, but enough that you can think about next year instead of just next week. You start making decisions based on what you want, not just what you can survive. And that sounds like a small shift, but it reorganizes everything. Here's the uncomfortable truth underneath all of this. The system isn't designed to help you get to $10,000. It's designed to keep you from getting there. Every fee, every penalty, every high-interest loan is optimized to extract maximum value from people who don't have cushion, because those people have no leverage. They'll pay whatever it costs, because the alternative is worse. But once you're across the threshold, you're suddenly on the other side of that equation. Not winning, just not losing as badly. $10,000 doesn't make you financially secure, not even close. It doesn't protect you from medical bankruptcy, doesn't fix a bad job market, doesn't stop inflation from eroding what you've saved, doesn't solve systemic problems with wages or housing costs or any of the structural reasons saving is hard in the first place. And it definitely doesn't make you immune to bad decisions. Plenty of people hit 10,000 and then immediately spend it on something that feels important in the moment, but isn't. The trap is thinking that crossing the threshold solves everything. It doesn't. It just moves you from one set of problems to a different, slightly less urgent set of problems. But here's what it does do. It buys you time. Time to think, time to plan, time to make decisions that aren't just reactions to whatever fire is burning hottest. In a financial system designed to punish people for not having money, $10,000 is the minimum viable amount to stop playing defense all the time. That's not freedom, but it's the first step toward having options. And most people never get there, not because they're irresponsible or lazy, but because the gap between $0 and $10,000 is designed to be almost impossibly wide for anyone starting from nothing. So the real question isn't what changes after you save $10,000, it's who benefits from you never getting there.